Good morning.
Morning, James. How are you?
I'm all right, thank you. Very good. Nice sunny day again. So we're going to talk about Henderson High Income. I know you've got a few slides. Even though people will no doubt have seen you on here before, it's just probably worth you just, for those that haven't, just introducing the fund and what it's trying to do, please, if you don't mind doing that.
Absolutely, sure. If you move to the next slide, I've got a picture there that kind of sums it up really in one picture really, because it's I kind of compare Henderson High Income to, I dub it the Ronseal of investment trusts, and that's because similar to the famous slogan on Ronseal, it does exactly what the name suggests, and that's to provide that high level of income to shareholders, but also the prospects of capital growth into the longer term. And you can really see that on the chart on the right hand side there. The current dividend yield on the trust is 5.9%, and although we've seen interest rates move higher, we've seen bond yields move higher, it's still a significant yield premium to bonds and cash, but also to the wider UK equity market space as well. Now, we invest in, I see it very much as a UK equity income trust, but I think the one thing that really differentiates us from the competition is our ability to own bonds. And I'll come on to talk about that in a bit, and how that should be seen, especially in the context of the gearing within the trust. But as I said, I'll come on to that. But James, if you move to the next slide, thank you. So the key attributes of the trust, it is well established. It was launched back in 1989, and it's grown to about 271 million of gross assets as of the end of July. We take a long-term approach in terms of the companies we invest in. Holding periods are typically between 3 and 5 years, and because of that, it's a fairly low turnover portfolio. We're very much focused on dividend yield and dividend growth. And I think it's key to us to focus on both those two elements. And I've got a slide on this later in the pack just to show you why it's important to focus on those two as well. I work at Janus Henderson. I think within the global equity income team, and I feel that we do have a very strong income heritage across the team. I work with Job Curtis, who you may know from City of London Trust. I work with James Henderson from Lord Adventure and Loden Trust. I also work with Alex Crook from Bankers. So there's a real wealth of experience, not just in income, but also in investment trusts as well. Chart on the right hand side there just shows you the dividend track record of the trust since I've been involved with it. And we've grown the dividend 9 consecutive years since I've been on the trust at a compound average growth rate of about 2%. And I suppose, that chart also shows you, how the revenues and how the revenue reserves have developed over that time period as well. And I think, just reminds you, I guess, of, the advantages of having an investment trust structure. Being able to utilize revenue reserves when when the dividend outlook is being more tricky, as it was in 2020. And as you can see from the chart, hopefully, we were able to utilize those reserves to be able to fund the dividend when, the outlook for market dividends at that time was pretty horrific, really. But we're still in a very strong position in terms of those reserves going forward as well. Next slide, James. So as I mentioned previously, I think the one thing that really differentiates us is our ability to own bonds, and that really is to help boost the overall headline level of income for the trust. So and that bond element is really funded through gearing. So again, utilizing the advantages of investment trust structure to utilize gearing to own bond assets to help boost that overall income for the trust. So where I can borrow at a blended average rate of about 2.5% and invest that in a broadly stable portfolio of bond assets yielding closer to sort of 4.5%, that's a good way of generating that extra income for the trust as well. So that's something that I guess as shareholders you need to get comfort of. There's always going to be this sort of structural gearing, that gearing that funds the bond portfolio. I suppose when you strip out that structural gearing, the actual gearing towards equity is around about 8.5 at the moment. So that's more sort of your tactical gearing, when we see valuations particularly attractive in the equity market. So on a total gearing level, we're about 21% at the moment. I want to try and explain to shareholders is, although that may look high on a relative basis versus maybe some other investment trusts, the majority of that gearing is backed by a bond portfolio, and that bond portfolio, generally stable assets, help dampen down the overall volatility of the trust. So if you look at the chart on the right hand side there, it just tracks the volatility of the NAV of high income versus the FTSE All Share. So despite the the relatively high level headline gearing, actually having that bond portfolio helps dampen down that volatility. So actually it's not too much different from what we've seen historically versus the wider UK equity market as well. Next slide, James. So this slide just really talks about the things we look for, our investment process, what we look for in companies, and I kind of break it down into three key parts really. The first is fundamentals. Now, what do I mean by that? It's really getting to grips with our companies, understanding what they do, how they make their money, and what their key attributes are. What we're looking for is kind of resilient business models. We want businesses that are going to be around for the longer term. Companies with high barrier to entries, difficult to compete away from either traditional competition or new disruptive technology. Market leadership, we like companies that have a strong position in their industries, force and pricing power, things like that. Strong franchises, strong brands, these types of things as well. Really trying to find, the value within a business. And good management teams. I think, if the pandemic has shown us anything, is you need good management teams to be able to steer these companies through difficult times. So that's one of the things we really look for in the companies. And then I think about financials. Analysing a company's financial health. We're looking for businesses with strong cash flows, robust balance sheets. Understanding how sustainable the company's margins, its returns are going forward, and also checking, is the company well invested? It's all very well being an income fund manager and wanting the dividends, but we've got to be sure that the company are invested appropriately in the business so it can grow, so that dividend can continue to be paid out to shareholders, not just today, but in the future, and can grow over the longer term. And then the final part is really valuation, and that really underpins the whole process. Whereas it's all very well funded, a good quality company, good fundamentals, and strong financials. But if it's in the price, then actually your capital return is rather limited. So it's about finding the right company with good fundamentals and good financials, but always paying the right valuation for that. Next slide, James. Now I talked about the importance of focusing on dividend yield and dividend growth, and these charts kind of explain why. Because dividend yield in isolation can be a misleading guide to value, and it's not about just owning companies with a high dividend yield, because that's a very dangerous. That could be very dangerous to your portfolio performance. And what the chart on the left-hand side there shows, the black bars show you what your forecast dividend yield was, and your orange bars show you what you actually got at different levels of dividend yield historically. And as you can see, the higher the dividend yield is, the less likely you are to actually earn that. So actually, we kind of look for dividends between that 2 to 4 and 4 to 6% range, because actually those dividends prove to be a lot more sustainable. Companies can pay that sort of dividends. If you look across to the right-hand chart there, this shows total returns in the UK market historically, broken down by dividend yield buckets again. And as you can see, that 2 to 4%, that 4 to 6% dividend yield range generally produces the best total returns as well. So that's why I always call that 2 to 6% dividend yield range is the real sweet spot for income investors. You get, good dividends, but also dividend growth. And the combination of those two produces your best total returns. And I think, again, it kind of goes back to the structure of the overall trust. Our ability to use gearing to fund a bond portfolio to help boost the headline yield means actually I don't have to be too far up the risk curve chasing the high dividend yield levels of the UK market, where clearly dividends could be under pressure and be cut in the future, or where your capital returns and your total returns are a bit more lackluster. Next slide, James. So that was that sort of first half of the presentation really was just talking about the trust. I've got a few slides here just talking a bit about market outlook, and obviously I'm happy to take further questions after this section. But, clearly there's a lot to worry about currently, whether it's surging inflation, cost of living crisis, monetary tightening. Clearly central banks around the world are increasing interest rates for the first time in years. And a lot of people talking about the risk of recession, not just in the UK, but further afield across Europe, across the US, and in emerging markets, etc. And clearly, there we've got heightened geopolitical risks. Who knows what Putin's going to do next within Ukraine, or whether he shuts off the gas supply to Germany, really, and what impact that could have. But I always say, there are still positives out there. One thing we've done entering this sort of slowdown is, generally corporates have very strong balance sheets. They needed to be, having to gone through the pandemic, having to, improve liquidity, improve strengths of balance sheets, etc. I kind of believe we're going through a capex cycle at the moment. 2020 was I think it was a 30-year low in terms of capital spending, and I think that's going to grow from there, because I think there's a couple of key themes out there. One being sort of industrial automation, and companies find it hard to find staff, etc. They want to become more efficient as well in inflationary environment. So I think they're going to be spending in robotics to make their plants more automated, to make it more efficient, etc. I think there's going to be a shift as well in terms of onshoring. Again, what the pandemic has shown us is those just-in-time supply chains coming out of Asia, do break down and do cause quite significant issues if there is a little bit of disruption out there. So I think you will see companies start to invest more in bringing facilities and manufacturing capabilities closer to their headquarters, etc. And then thirdly, I think the amount of spend we need to put through to transition the global economy to a cleaner world and cleaner energy. I think that investment in energy infrastructure again is going to be a significant boost to sort of GDP as well. The other points are, we are in a tight labour market. Unemployment is low, vacancies are high. So if people can keep their job, actually that should still support the economy as well. Next slide, James. And one thing I also wanted to point out is, not all recessions are equal. You probably would have seen the headlines from the Bank of England report last week, talking about they're now predicting the UK does go into recession. But I wanted to put their forecast into context, which you can see on the right-hand side there of the chart. That orange bar shows you what they're forecasting in terms of UK negative growth over the next few years. And now, clearly forecasts of, are prone to errors. But again, I wanted to put it into context for recessions we've seen previously versus, the early 90s, the early 80s, the global financial crisis, and, make the point that, even if the UK does go into recession, it doesn't necessarily have to be a severe recession. If you think back to the global financial crisis, we had a huge credit boom leading into that. Lending standards were pretty lax, and balance sheets were weak, and capital ratios on banks were pretty weak. So, that's why we got a credit crisis. That's why it was such a severe recession. You haven't got that this time around. We haven't seen huge lending growth over the last few years. Banks' balance sheets are incredibly robust at the moment. They've had to be. The regulators forced them to do that. So again, I don't think you're going to get these, seismic financial crash, if you like, therefore, which wouldn't necessarily cause such a severe recession as we've seen previously. Next slide, James. Also, the other thing I wanted to point out, which I think is really interesting, the UK market, you may have known, the UK market has been pretty resilient, I guess, versus overseas market. The FTSE 100, as at the end of June here, these figures was only down 1%. And that's a material outperformance versus, say, the US market versus Europe, etc. But actually, once you dissect the FTSE 100 into the top 20 stocks and the bottom 80, you can see there's a clear differentiation between performance of those stocks. The top 20 stocks, so these are the biggest 20 stocks in the UK market, the oil and gas majors, mining, banks, etc. They're up 10% year to date. The next 80 stocks within the FTSE 100 are down 22% or nearly 22%, which is more in line with the performance we've seen in the FTSE 250. So although the headline level of the UK market looks to be performed a resilient performance this year, actually very much skewed towards the biggest 20 stocks in the FTSE 100. And actually the majority of the market by number, actually they're already in a bear market. So yes, we're going through a slowdown. Yes, there's recession risks, but the market has started to discount that, and share prices have already fallen quite significantly already. Next slide, James. And then we sort of come on to valuation then. I kind of look at the UK market on a CAPE PE, so cyclically adjusted PE, so it's based on 10-year average earnings to try and smooth out cyclicality. And as you can see from the orange bar there, which represents the UK's CAPE PE, you know, the UK market is cheap, not just versus the US there, but also versus its own history. And don't forget, the UK market is still an attractive market for income. You know, currently the forward dividend yield in the UK market again is sort of 3.8%. There's a clear premium to all those other overseas indices as well. So, you know, yes, there's risks out there. As I said, there's positives. UK market has already been weak. You know, if we do go in a recession, it may not be severe. The valuations are still pretty attractive. So yeah, I'm happy to sort of leave it there and open up to any questions you may have.
Great, thanks, David. So let's deal with one thing first. So in terms of the stocks that you're buying then, so really these, would you pigeonhole them as value or growth, or are they not either?
I'm kind of a bit more pragmatic. I'm not out and out value. Clearly, you know, with an income bias, I'm not out and out growth. I'm trying to find good, I suppose it's quality income. I would describe my sort of style as, you know, finding good businesses that pay a good yield that can grow into the longer term. Yeah. But you know, but making sure you don't overpay. So still a valuation discipline.
So are we talking sort of like market levels of growth then, in terms of earnings?
Yeah. So really, it's trying to find, I suppose, it's sort of growth at a reasonable price plus your yield, that sort of thing. So you know, a Diageo would fit into that class. You know, it's a really good quality, high quality business. The yield is say 2.5% now, but I'm happy to own that company as long as it's delivering me better dividend growth than the market. So the dividend growth is probably more like 10% plus at the moment. So I'm happy to own some of the lower yielders that deliver higher growth. Now, clearly, I've got to offset that with, you know, some high yielders elsewhere in the market. But again, it's making sure you're disciplined about buying, you know, good quality companies. So, you know, Anglo American, you know, the miner, you know, is benefiting a lot from the high commodity price environment as well, paying a big yield. But fundamentally, it's a good business with a good diversification in terms of the end commodity exposure, being iron ore, copper, and PGMs as well. And actually, they're pretty good at what they do, and they've got high quality assets. So does that give you a bit more of a feel about you know, the companies we invest in?
Yeah, I think so. Thank you. Let's come back to this one. So this chart here, the dividend yield range one. Because I think that's interesting, because you'd think that people have got so fixated on you just have to buy growth, and growth generally doesn't yield anything, and it's all about returns in the long term. But that's saying over quite an extensive period, no, you don't want to be owning that. You want to be owning kind of like established companies that are doing okay and paying you dividends. Do you think we're going to see I think the market maybe is expecting a switch back into these sorts of stocks. Then maybe that's not going to happen.
Yeah, I think, you know, there are, you know, as we've seen from history, there's clearly times to own zero yielding high growth companies, whether that was the lead up to the TMT bubble, whether that was, you know, more recently, you know, the big tech boom that we've seen certainly in the US and the NASDAQ over there. But I think if you look at, you know, and that's all predicated on, you know, multiple expansions. If you look at analysis over the longer term, the majority of your total returns has been proven to be dividend yield and dividend growth. Now, multiples, PEs, etc., will expand and contract depending on where we are in the cycle. But one thing that always consistently, if you can find a company that can pay a good yield and pay a dividend yield and grow that dividend, that will serve you better over the longer term than, say, relying on just P expansion. Because, as with always, with the market, things do get, people do get over exuberant about things, and multiples do expand, beyond fundamental value, and that multiple will come back again. So that's like I said at the start, I guess it's, there are times to own obviously growth stocks and income will come out of favor, but over the longer term, dividend yield and dividend growth has proved to be a reliable source of total returns consistently.
Thinking about this gearing here, so one of the questions is, would you actually cut the tactical gearing if you think we're going to a recession?
Yes, I mean, to be fair, we've actually lowered it quite significantly over the last sort of 6 months, all through this year. Really, we've taken about 12 million out of equities and used that to pay down the borrowings, and so lowered that gearing level by about 5%.
What sort of margin are you getting on the income from the bond portfolio? So what you're paying to what you're getting on as a coupons?
Yeah, so we can, the blended average rate of our borrowing is about 2.5%, and that's both through, we got a bank facility, but also longer term private placement debt, and the yields we're getting at the moment in the bond portfolio, around about sort of on average about 4.5% at the moment, and I suppose within the bond portfolio, we own kind of, we've moved into sort of US investment grade credit. So utilising, where we've seen quite a large move higher in bond yields, certainly in the US, since the turn of the year, really, we use that as an advantage actually to increase the bond exposure, getting yields on, around about that sort of 4.5% level in pretty good quality credits, actually, things like Amazon bonds, AbbVie bonds, pharmaceutical company, Broadcom, the semiconductor company as well. Now we also own a bit of UK high yield bonds as well, but typically where we go into the high yield bond market is generally in non-cyclical, reason to exist companies with strong cash flows that can command probably extra debt on their balance sheet, hence why they have slightly lower ratings there. Just to make the listeners aware, we in terms of the management of the bond portfolio, we outsource that to John Patino and Jenna Barnard in our bond team, who you may know from Henderson Diversified Income Trust. So obviously, expertise in the bond market, really.
Exactly. Now where are we? Where's your? No, this is the revenue reserve chart here, isn't it?
Yeah.
So, to answer one question straightforward, yes, you have had to use revenue reserves in recent years, and I suppose that chart is saying that blue line is saying you can pay 2/3 of the whole year's dividend out of revenue reserves. Is that true?
That's correct. Yeah.
Yeah. In terms of the income that you're getting, though, is all of the income from the portfolio kind of back to pre-pandemic levels?
Is the income back to pre-pandemic levels? I would hope so by the end of this year. So I think the way I think about it is, clearly we can't keep using revenue reserves forever, but hopefully, given and you can kind of see it from the chart, the amount we had to use from revenue reserves was quite marginal last year. About 500,000, I think, in terms of absolute numbers. So, and I suppose given the outlook for underlying dividends for the wider UK market this year, I think the Linked Dividend Monitor has got it up. We'll forecast it to be up 11% this year. I think if you assume that a sort of similar growth rate in our underlying dividend, then you should be in a position where we hopefully could cover that dividend this year.
Okay, great. Obviously, we've seen quite weak markets. We know that private equity's got a lot of money standing by. Do you think that you're going to see a big uptick in M&A activity this year?
Well, I think you're kind of seeing it, aren't you? You know, I think, was it 3 out of 4 bus companies have been bid for in the UK, Euromoney's been bid for, you know, et cetera, et cetera. You know, I think, you know, the valuation disconnect between the UK market and elsewhere at the time when you've had, you know, bond yields as low as you have, you know, has really instigated that tick up in M&A we've seen over the last few years. And I don't see that, you know, changing materially, because even though the outlook for growth is slower, I think if you're a corporate and you're taking a longer term view, you know, given where valuations are in the UK market, I think there's still quite an attractive opportunity to, you know, lock in still cheap money. I know bond yields have moved up, but it's still pretty cheap when you look at where bond yields have been over the last sort of 20, 30 years. So it's still an opportunity to lock in that cheap finance and go out there and buy, you know, good quality companies on low valuations if you take a bit more of a longer term view, really. So I think it might be a trend that continues, really.
Okay. What about share buybacks? The question here is talking about things like Barclays, NatWest, BP buying back a lot of stock. Is that something you expect to continue?
Yeah, I think certainly buybacks is a good way for companies to utilize their excess cash flow, because it is, you know, it is quite flexible. You know, if for whatever reason the economic outlook is worse than we're predicting, etc., or a company gets into a bit more trouble, etc., and they're, you know, it's something they can turn off quite quickly. You know, and that's why I think companies like to do it over maybe, you know, boosting their ordinary dividends, because it's, you know, much harder to cut your dividend, etc. I think companies need to be very disciplined on it, though. You know, you can't just keep buying back shares with disregard to your valuation. You know, if you believe your valuation on your company is too cheap and it's below the intrinsic value, then by all means return cash via buybacks. But if the valuation is not and it's high, then surely there's better ways to allocate that capital and get a better return just by investing in your business, really.
Banks, you've got NatWest there. Do you think banks are actually set fair at the moment, given interest rates are going up, or are you more worried about rising bad debts?
I think I kind of feel that actually the benefit they're getting from higher interest rates, you know, clearly you're seeing that coming through in the numbers. You know, both Lloyds and NatWest, the 2 main UK ones I hold, you know, their results are pretty robust actually and beat expectations. So actually your beta, your exposure to that interest rate is coming through a bit higher than people thought. So I think that is going to lead to higher earnings, higher dividends, more specials if you're in that West case, and I think that will help underpin the share prices from here, irrespective if we go into recession. I think if you look at the provisions the companies took during the pandemic, which haven't been fully released yet, actually those reserves were based on pretty bearish assumptions. Therefore, I think there's a buffer there for those provisions to actually protect the company from any impairments they might see going forward. So I think they've already taken the provisions. I think that you know the write-offs you might see are already protected from those provisions. At the same time, I think the dividends are going to surprise to the upside going forward. Now, when you look at the valuations, you know, the companies are pretty confident they can get to, you know, the likes of Lloyds and NatWest. We're talking sort of 12% return on equity. You know, typically for those types of business, for doing those returns, you probably would expect to pay 1.2 times book, but at the moment they're trading below book, and that's because I think, you know, people are worried about the impact on the loan book. But if you don't see the write-offs, then these things shouldn't be trading below book.
Yeah. There's a question, I suppose, it's kind of perennial question about BAT. So what's the argument for holding BAT if the trend is generally for less and less people to smoke?
I think that trend you've seen for the last 40 years. Volumes have been going backwards for quite a few decades now, but yet the company's still able to grow its profit pool because it has such strong pricing power. So whatever, even though your volumes are going down, your price is going up, actually your profits grow in that environment. Now I think for bats, it's clearly gone out of favor the last few years. It's got pretty strong cash flows, and it can pay a pretty attractive dividend, and not just pay it, can actually grow it sort of high single digits each year. So I think that's quite valuable. And I think it's the market is because of, I guess it's tobacco and smoking is not everyone's it's not everyone's choice for doing it or quite frankly investing in it, but I'm kind of happy to invest in tobacco because I think the cash flows are fundamentally undervalued. And I think bats are actually doing the right thing in terms of the investment they're making in next generation products, be it vaping, be it heat not burn, be it modern oral, etc. So it does feel to me that they are trying to shift the business. Now it will take time, don't get me wrong, and the majority of the profits are coming from tobacco, traditional combustible cigarettes at the moment. But they're doing the right thing in terms of making sure they're investing for the longer term to make sure that they are going to be relevant in years to come, as traditional cigarette smoking does continue to decline. And now, one of the things I think that, going back to your point on buybacks, I think one of the things that has supported the likes of Bats this year is their announcement that they were going to start buying back shares. Clearly they see value, or clearly they think the market is undervaluing their cash flow. Therefore, why not buy back shares to prove the market your valuation is cheap? I think that's been one of the reasons why Bats has been quite good. It's a signal to the market that they're pretty confident in their cash flows.
But what we don't see in that top 10 is BP and Shell. Why don't they feature?
Yeah, I mean, I do own both companies. Clearly, the current high oil price environment, has been beneficial to their cash flows. I am typically underweight the sector versus where the benchmark is. I think it's more to do with fears over probably the transition to cleaner energy, and just the structural decline we're likely to see in oil over the longer term. Now, the companies are investing, and they do have plans to invest in renewable energy, etc. I just feel though that they're going from investing in oil and gas projects which typically make a return of say 20% into renewable projects that at the moment only make sort of 10% returns. So shifting from a high returning business to a lower returning business over the longer term, I'm not sure that is necessarily a really good journey for shareholders to be on. I mean, I think it's the right thing for them to do for society, etc., and climate change. But it's going to take time. I'm not sure about the returns they're going to be making. Hence why I have some holdings in the sector for, clearly cash flows and dividends are attractive at the moment. But I'm typically underweight because I do worry a little bit about their transition plans and what that means for returns going forward.
Okay. So obviously that's a bet against the index. What's your active share overall?
Active shares around, for the equity portfolio, around 65%.
Okay. Yeah. So not sort of following the index by distribution.
Yeah.
Do you actually hold any zero yielding stocks?
So the only zero yield we've got at the moment is National Express.
That's timely because there's another question about that as well.
Okay. Yeah. So we held it pre-pandemic. Clearly the business got incredibly impacted by the pandemic, etc. Had to cut its dividend, had to raise equity. We were happy to support the business in its hour of need and supply new equity into the business, etc. And I think it's just a matter of time before that dividend comes back as a recovery in transport, etc., comes through really.
Okay.
And what was this? Was there a specific question on National Express?
Well, yeah, I was just saying, what's the attraction of the National Express?
Yeah, I think it's materially undervalued, if I'll be honest. Because if you look at, I guess, consensus forecasts has got the business probably reaching back to pre-pandemic profitability back in, I think, the year 2024. So still a bit of recovery to go for. And on those earnings, assuming it can get back to a full recovery, then the business is only on 7 times earnings PE. Now the business has got a growth strategy. Now they think they can grow. Revenues by a further billion over the next 5 years. So it's kind of one of those stocks where it's not priced for even to recover to pre-pandemic levels, let alone the extra growth that they think they can deliver going forward. And also, because of that extra billion they think they can grow the business, that translates into 1.25 billion of cash flow. That cash flow is bigger than the current market cap. So, I think it's really quite interesting at the moment. And let's not forget, as I kind of mentioned earlier, 3 of the other 4 bus stocks have been bid for in the UK. So there's clearly interest in the sector. Now, I think National Express is probably a bit too big, probably a bit too diversified. But it just highlights the value within that sector that other people see, that maybe people are not recognising in National Express.
Okay, thank you. Henderson Income is sort of the only fund in the AIC's UK equity and bond income sector. Is that sort of sustainable? Do you think it should be better placed in the UK equity income sector?
It's certainly something we discuss at the board level. I think if the ISC allow us to stay in that sector, then I think we're happy to, because I think it kind of plays into the uniqueness of the trust. Our ability to own bonds is our unique feature. It is the factor that differentiates us. So why not highlight it by being the only trust in the sector, really. Having said that, if we had to move to the ISC UK equity income sector, I think the yield level that we deliver, I think our performance, we'd still stand out in that sector as well.
Yeah.
So I'm agnostic, but I think why we still can, highlighting that attraction of the differentiating bond factor can only be a good thing.
Yeah, exactly. Okay. And I suppose that's what differentiates it from the other income funds in the Janus Henderson stable.
Yeah, absolutely. We're all, even though, myself, Job and James work very closely together, we all have, slightly different views on companies, slightly different portfolios, really. And actually the commonality, I think I did a bit of analysis a few years ago, just looking at the commonality between the UK equity portfolio of high income and the City of London, and actually there's only about 65% overlap or commonality, really. So they are different things. City is very much large cap focus. I suppose James Henderson of Lowlands is more sort of mid and small cap, and I kind of feel like I'm a bit more in between, a bit more blended. I'm happy because of the size of the trust. I can quite flex it between large and small cap and move about a bit more.
Is there an open-ended version of what you're doing here?
Not really, not on Henderson high income, just because I suppose we utilize the gearing to really generate that extra income. Yeah, so you couldn't quite do that in an open-ended fund.
Good. All right. The other question, sort of going back to how you run the portfolio again. I think we've got 5 minutes. First off, what's the sort of average holding period for a stock?
Yeah, so it'd be typically between 3 to 5 years. Now clearly there'd be some companies that I have owned since I became a fund manager, really, and there'd be some companies that will typically, whether it performs very robustly on, when you first buy it and you come out quite quickly, etc. But on average, it's kind of 3 to 5 years.
In terms of like ESG, I'm assuming you do engage with companies. Is there anything example you could sort of cite of that?
Yeah, sure. So the one that always springs to mind is it's actually from last year. It's when we engaged with Compass Group following the Marcus Rashford campaign for free school meals. You may remember that one of Compass's company charters came up in the press about its, the free school meal parcels that it delivered were pretty substandard, which is pretty disappointing really as a shareholder in Compass. So we engaged with the company, we got in touch and said, look, can we talk to someone in charge who's responsible for this and find out what the company is doing. And they were happy to have a chat with us, say it was a mistake, we've realized our errors, we've put better controls in place to make sure it doesn't happen again. So one of the great things about being an active manager is we do own positions in companies, and we do utilize our vote and our shareholding to engage with companies to find out what's going on, to try and put things right, to try and influence shareholders, to influence management teams, etc.
Well, then the last question I've got on here is there anything new in the portfolio you want to tell us about?
So I suppose one of the new holdings that I bought fairly recently is Devro, which makes sausage skins. Mm-hmm. It's quite I think it's a business that I think people see it as an unsexy business, making sausage skins, but I quite like it just because it's in that food producing sort of sector. So it's quite a resilient, or should be fairly resilient business. It's a good business as well. It makes, it's a global market leader. It makes good returns, good margins. It's got a very good cash flow, and it's got high barriers to entry because of its technical know-how, but also the scale of its manufacturing assets. It has lost focus over the last few years, but I think the relatively new management team are really getting back to grips with focusing on commercializing the business a lot better, which I think can accelerate volume growth going forward. And I think you're starting to see the evidence of that come through. There's certainly higher growth rates now in the short term. It's got the energy bills. One of its biggest costs is energy. So I think that's dampening down its margins at the moment, but you are seeing good pricing coming through to try and offset that. So actually the earnings are beating expectations at the moment. And yet despite some of that sort of returns, margin profile, the growth drivers, it still trades on 10 times earnings, yielding 5% with a pretty robust balance sheet. So I think it's one that people miss because they just see what it does and you think it's pretty unsexy, boring business, but that returns profile I think is materially undervalued at the moment.
Oh, great. Well, good luck with that. I think on that note we should wrap it up. But thanks very much for this morning, David. It's really interesting.
No, that's absolute pleasure. Thank you for having me.
Some performance numbers there. Obviously, there's the up-to-date stuff on the website of Henderson Income and also on QuotedData, and the very important compliance stuff. There we go. Good. So we'll be back as usual next week. As I think we've got a sort of full lineup, as I said before, running through for quite a while now. So next week will be me talking to Fiona Yang of Invesco Asia. So that should be an interesting one, I think. Because she's been co-managing it with Ian for a while now. So we'll see you again next week. Thank you very much for tuning in today, and have a good week.